More than $6 trillion vanished in about 1 hour. Gold dropped hard, silver dropped even harder, and it's not just the crash. It's that most people don't know the reason behind it. Liquidation triggered liquidations, stop losses got hit, leverage got wiped out. But this wasn't random. There is a pattern behind it. They crashed the price, they blocked the exit, they raised margin, they forced liquidation. If you want to design a system that transfers wealth from retail to institutions, you would design it exactly like this. Hi, my name is Lamia, and in this video we're going to break down what just happened, the structure behind it, and the key signal most investors ignored. And stay with me until the end, because I'll show you the pattern that usually appears right before the market turns and what I'm personally watching next. So without further ado, let's get into it. There is one chart professional traders watch constantly, and most retail investors barely look at it. It's called the DXY, the Dixie, the US dollar indexed. The Dixie measures the strength of the US dollar against a basket of major currencies like the euro, the yen, and the pound. And here's a relationship that changes how you see the market. When the dollar goes up, gold and silver often goes down. Not perfectly every time, but often enough that ignoring it becomes expensive, because gold and silver are priced in dollar, and stronger dollar means fewer dollars are needed to buy the same ounce of metal. So the dollar denominated price drops. Think of it like a seesaw, dollar on one side and metal on the other side. When the dollar raises, metals tend to fall. That's the market mechanics. So the real question becomes, why did the dollar spike? It wasn't one single headline. It was multiple pressure landing at the same time. When the Federal Reserve signals that interest rate may stay higher for longer, the dollar became more attractive. Higher rates means higher yields on a dollar assets. Foreign capital flows into dollars. Demand rises, the dollar strengthens, and metal feels pressure. At the same time, silver reacts different than gold, because silver isn't only a precious metal, it's also industrial. For example, it's used in solar panel, in your phone, in laptops, electric vehicles, semiconductor, and even large data centers. A large portion of silver demand depends on manufacturing activity. So when markets fear economy slowdown, silver often reacts more sharply. And according to official Chinese manufacturing data, factory activity recently slipped into contraction, which signals weaker industrial demand. There are also geopolitical factors that influences precious metals over time. Tension in regions like the Middle East, including situation involving Iran, increased uncertainty and often push investors towards safe haven assets like gold and silver. But geopolitics usually add volatility and sentiment shift. It doesn't always explain a sharp crash by itself. It's one piece of a much bigger puzzle. And then there's uncertainty in general. After strong rallies, many participants look for opportunities to lock in gains. Once price starts falling quickly, stop losses trigger, margin call activates, forcing selling begins, liquidation trigger more liquidations. That cascade creates the rapid red candles people see. Gold and silver often move in the same direction, but not with the same strength. Silver is more volatile. When gold drops 5%, silver might drop 10%. When gold rises 10%, silver may rise 20%. It's the same structure, just intensified. Silver to gold is like Ethereum to Bitcoin. But here's the key point. In a short-term crash, sentiment changes faster than fundamentals. Price can move quickly. Crashes shake out leverage position. They reset momentum. They change sentiment. They don't automatically change the long-term thesis. If you hold physical metals, treat them as long-term saving and insurance, not day trades. If you trade with leverage, remember, leverage magnifies both gains and losses, and liquidation happens fast. If you're in cash watching, volatility can create opportunity, but scale in carefully and manage risk. What I'm watching next is simple. The dollar, Federal Reserve messaging, China economic data, and overall uncertainty in the market. These signals often appear right before the next major move. There are three types of people after a crash. One panics, one freezes, one learns. Markets transfer wealth from the emotional to the prepared. So hopefully this gave you a clearer picture of what really happened and the key factor behind it. If you see it differently or you noticed something I didn't mention, put your thoughts in the comment below and let's discuss it. And if you want more real updates, follow us on X and also join our Telegram community. We're growing there and sharing things as they happen. Thanks for being here and I'll see you in the next one.